Well, look at how far we have come. It seems like everyone is essentially trying to jump onto that China bandwagon in today's increasingly challenging market. So more and more of such bulge bracket banks are explicitly signaling support for Chinese equities. First, you have Citi upgrading Chinese shares as outperforming, Bank of America securities suggesting that short-term corrections in Chinese shares can essentially be seen as a buying opportunity, and also UBS estimating that Chinese shares would continue to outperform the global equities market over the next few months. However, Goldman Sachs seems to claim that China is no longer on sale, but the outperformance case stays intact. Effectively, they are just hedging the downsides. Chinese equities no longer on sale, but they can still outperform. What does it even mean, man? My simple brain cannot understand such complex theories, but I can understand that smashing the like button is the right thing to do, so don't let it go. Anyhow, Goldman's position is simple. They put forth the argument that China is back on track, but the US or even the global economy has a looming recession risk ahead. So given the backdrop of the continuous reiteration of a 5.5% GDP growth target set by the CCP and also echoed by Chairman Xi himself, we might be expecting some sort of policy easing and even a pandemic normalization in the second half of this year. So they did argue that comparatively speaking, Chinese stocks might no longer be on quote-unquote sale, given that China internet stocks were rallying at least 45% from its bottom in mid-March. So with the global recession risk rising, index valuations are currently having re-rated to the middle range, and having a depressed global investing environment will probably have an adverse impact of Chinese equities realizing their potential. So this is just simple investor sentiments. So on top of that, you still have the risk of earnings being impaired because if the global recession has a knock-on effect, ADR delisting, geopolitics, and the perpetual lockdowns. So simply put, if you were to compare to the March lows, of course, it's not going to look as cheap. But on an absolute level, I think there is still quite a long way to go for Chinese equities. But that's of course my own humble opinion. What do I even know? Just a random guy on the internet. So that being said, Goldman still asserts for China's outperformance based on three main factors. Number one, China appears to be much more well positioned in its growth, inflation, and policy cycle versus the rest of the world. Number two, China usually performs well in the second half in the run-up to the Party Congress. Even though there is no elections to begin with and it's essentially an inside job and there is no special interest groups to pander to, there is no big pharma or military complex, but it's always good to start off the new term with a green portfolio. Wink wink. Number three, the fund's positioning and rising demand for non-US equity beta. For more layman understanding, everyone is essentially starting to diversify away because of the upcoming potential storm ahead. So Goldman is specifically overweight on 5 key sectors: autos, consumer durables, media, retailing, and semiconductors. And they basically just listed most of the profitable big tech with a buy rating. So I'd just like to remind everyone that this is just Goldman Sachs' view. Use it as a form of reference and don't get too butthurt in the comments saying like, oh, what do Goldman even know? All these bulge bracket or investment banks always give wrong advice and are just chasing the price target. For one, they are part of Wall Street, so I'm sure they know a lot more compared to us. But, a big but here, we are essentially all playing a different game compared to the institutions out there. So just take their guidance with a pinch of salt and don't take things too seriously. It also recently broke the news that after a year-long wait, Goldman Sachs and ICBC can begin their wealth management joint venture as they've recently gotten the green light from the regulators of the government to essentially start operating. So Goldman Sachs will have a 51% stake, while ICBC has a 49% stake. So this wealth tie-up isn't the first in China, by the way. So Europe's Amundi and the Bank of China were the first, and they have taken in more than $11 billion in assets in the year and a half after launching it in late of 2020. So for clowns on the internet still talking down on China, oh, it's just being run by a bunch of communists and people in the party and they're basically just driving the economy to the ground. For people who are unaware, ICBC is the largest bank in the world by assets. Oh, and by the way, the next three are also all Chinese banks. Welcome to the world. JPM is ranked 7th and Bank of America is ranked 9th. I know, certain infrastructures and industries have yet to mature. And people love comparing the China of today with a lot of the developed counterparts like the EU, UK, US, etc. Chill bro, they only have a GDP per capita of like what, 11,000 US dollars. You're comparing countries at different stages of life, very much like trying to compare Tesla to Coca-Cola on its growth curve. What are you essentially trying to prove? I don't understand. So just give them some time to do what they have to do. And I love the colloquial saying, so you just need everyone in China to spit at you. You'll be drowned. That's just the power of scale and numbers. It's not rocket science. Even though everyone is quote-unquote relatively poor, as long as they keep going at it, every $1 is increased and magnified by a factor of 1.3 billion. So to be very honest, just flip the roles and think about it. If you are not a threat, why would people be scared of you? Currently, the biggest issue still lies in the strict capital controls in China. But if you were to really think of it from the government's perspective, they have their own dilemmas. Evolution and change takes time, and for one, since money can't technically leave the country, they're trying to quote-unquote import the solution first, which is why there is so much wealth management collaboration. Sure, haters will continuously harp on the fact that how authoritarian and worried the government is. But you can't deny that we are seeing progress. Whether the speed of change is to your liking or not, that's another topic for another day. Goldman's own research predicts that by 2030, China will have some $70 trillion worth of assets invested in some form or another. More than half of it will be non-deposit products, such as wealth management products, as well as securities and mutual funds, etc. So I think people tend to underestimate the amount of wealth that will be gushing into the market once the overall literacy of the population gets slowly lifted up. So to be extremely frank, the stock market mechanism is the easiest and most effective way to achieve quote-unquote common prosperity, which is a very famous term. Think about it. So you just need proper education. So if you were to just observe the general trends in terms of fund flows, since last January, Asia, not including China, has posted cumulative foreign capital outflow of $111 billion, outnumbering the $93 billion locked during the global financial crisis. But let's not forget that this is on an absolute basis. And if you were to compare to the 08-09 crisis and given the rate of printing, I don't even know how much they are worth anymore. So China, on the other hand, has seen an improvement in terms of capital inflow. So solely in June, the Asian market, excluding China, recorded 21 billion in capital outflow, while the A-shares market tallied 11 billion in capital inflow through the northbound leg of the stock link-ups between the Chinese mainland and also Hong Kong. So numbers don't lie, and don't get blindsided by your own emotions and your own predispositions. So furthermore, the stability of the renminbi since late May that has seen the Chinese currency only weakening slightly against the USD, while the euro, the pounds and the yen were struggling with a dive versus the dollar. So even though we kind of know that the renminbi is a manipulated currency, but it does seem like there is currently a quote-unquote reluctance to depreciate the currency to encourage exports. So is this a bit to exacerbate inflationary problems in the rest of the world? Who knows what's the master plan here? Anyhow, circling back to investing on an individual basis, it's good to roughly understand of what is happening on the macro level. But at the end of the day, it still depends on the fundamentals of the company that you are getting yourself into. Don't get too carried away with the idea of, China has a great deal of potential, and just start buying up heaps of securities in the Chinese market without understanding the underlying business, and just because it's China. So let's still practice a certain level of responsible investing and do some fundamental analysis. I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye!